Hello, welcome to our monthly performance monitor. My name is Barney Hawkins, Investment Director at True Potential. Clearly, the key topic looking back was the recent sell-off in markets and the spike in volatility. Although unsettling, markets have recovered much of the lost ground, and the general consensus seems to be that the sell-off was more of a correction than the beginning of a sustained downturn. Our managers point to the strength of the global economy and strong company earnings figures, and believe that although we've seen a reaction from markets, the favourable picture of the global economy remains unchanged. While some managers have adopted a wait-and-see approach, others have taken the opportunity during the sell-off to buy on the dip and have added to risk assets. The UK is one of the few markets dividing our managers. UK equities appear attractive from a valuation standpoint, particularly compared to the US. However, volatility in sterling and uncertainty around Brexit are both worrying. Mark Carney's comments that the UK is likely to raise interest rates suggest that the Bank of England is looking to take advantage of strong global growth to move interest rates to more normal levels, and this is creating volatility. That said, some managers have been using the recent pullback to add to the UK, concentrating on the FTSE 250, which is made up of more domestically focused companies which are less sensitive to movements in the currency. In the US, attention is focused on the new head of the Federal Reserve Board, Jerome Powell, and what course monetary policy will take under his leadership. Interest rates have been rising in the US, and the Fed has indicated 3 further rate rises in 2018. There's no doubt that the economy is strong, and the recently announced tax cuts will add further stimulus to an already established growth trend. However, company valuations remain high, and markets are uncertain as to how far interest rates will be raised and what effect their raising will have on financial markets. In Europe, near-term concerns focus on political maneuverings. Angela Merkel has finally been installed for her 4th term as German leader, but the election result in Italy leaves the Eurosceptic Five Star movement as the leading party, but without a clear majority and unwilling to form a coalition. The partnership between France and Germany appears to be strong once again, but looking longer term, there is only so much that the two countries can do on their own. That said, across the bloc, economic growth is accelerating, and while the program of quantitative easing is being scaled back, the implementation of any interest rate rises in Europe appears a long way off. Looking to the Far East, Japan's recovery is becoming increasingly established, with the financial markets sustained by good economic numbers and continued quantitative easing. Emerging markets too look attractive and are pricing on a discount both to developed markets and their historic valuation levels. Attention remains focused on China and also what effect US interest rates may have on valuations, but fundamentally, macroeconomic conditions remain attractive. As central banks around the world work towards policy normalization, aligning current levels of economic growth with appropriate levels of interest rates, financial markets are likely to remain volatile. While this process may prove unsettling, it is important to look to the long term and remember that higher interest rates are indicative of a growing global economy. Thanks for listening, and we'll see you again next month.